My name is Chris Porter. Uh, Support Kansas City had asked me to put together a presentation on primarily health insurance, but I included a lot of employee benefits just to provide some additional information. With companies having all sorts of different employees, ranging from one or two employees on up to even hundreds of employees. I set up this presentation to be a little broad. So definitely as we're going through, or it may even be better to wait till the end, feel free to ask me some particular questions that might be able to help your organization, or even you feel free to email me after the presentation. I'd be glad to chat with you as well. Within the employee benefits space, particularly with health insurance, one thing that I've always found kind of interesting is the history of health insurance. With that history, a lot of people think about how things are currently, but they don't really think about where it all started. And that's one aspect which I kind of find to be a little bit fun. So health insurance initially started very, very different. It was set up on a model that looked very similar to workers' compensation, with sickness funds going back all the way really to around the Civil War time, but then going up until about the 1920s. After that, we get into the 1930s and we have the beginning of Blue Cross Association. So Blue Cross is technically a nonprofit itself, and that's when hospital service plans. So they had programs set up to help with actual, inpatient hospital services in the 1930s. Then as we start getting into the late 30s into the 40s, the Blue Shield side of it came on. So that's when we started getting to see Blue Cross and Blue Shield paired together. And that Blue Shield aspect of those services was more on the medical services, so doctor visits, for example. With that, those medical service plans started out on an indemnity type of basis, which what that means is it looks similar to like your Aflac or Colonial Life, or those types of supplemental coverages where you get reimbursed for services that you have. And then once we start getting into World War II era and then beyond is when private health insurance really took on and started to look more and more like what we have today. And then, of course, later on, we had the introduction of HMOs as well as Medicare and Medicaid. Then more recently, things like the Affordable Care Act and leading up to the type of coverage that we know now. So that chart listed there shows the percentage of population of private health plans going back to the 1940s on up. Of course, this doesn't go all the way to today, but kind of gives you a good idea of what it looked like, historically, which I kind of thought that was interesting. That's something ever since I started working in insurance that I found to really kind of pique my interest. So I wanted to share that with you. Related to health plans, again, knowing that companies have all different sizes of employees, there's going to be a lot of different options out there. So there's options for employers that have fewer than 50 employees, kind of grouped, and then types of coverage for employers with 50 or more employees. So I'll just kind of talk through each of those and kind of give some more broad examples of those types of plans and what can be done with them. Related to health plans for companies with fewer than 50 employees, especially fewer than 50 employees that are enrolled, we still have some grandfathered health plans, so plans that started before the Affordable Care Act started, that these types of plans, they can no longer be written. They were only available prior to the Affordable Care Act starting. But if a company does happen to have this type of plan, it is still each renewal, the the broker that's working with you, if you have this type of plan, can negotiate on that type of plan and help with pricing there when it's possible. With this type of plan, the renewal each year is based on kind of the claims activity or the health of the group as a whole. Next, we've got the Affordable Care Act compliant plans. So these are the plans that started after the Affordable Care Act started. Technically, a company cannot be declined on this type of coverage. So if you have 2 or more employees, you're eligible to get an ACA compliant plan, employer-sponsored plan. The pricing on these plans is going to be based on the age of the employee, age of each of the dependents that's enrolled as well. These health plans are not negotiable. The pricing is determined by the health insurance carrier prior to the start of each year, and that pricing has to be approved by the Department of Insurance for each state. So really, if you are looking at this type of plan, there's just a rate chart that has already been predetermined, and it's just going to be based on the age of the employees that are enrolled in that type of program. Next, we've got level funded plans or MEWA plans. With these types of plans, they were available prior to the Affordable Care Act, but they really took off and became a lot more popular after the Affordable Care Act. The reason for that is that the pricing on these plans, as opposed to the ACA compliant plans on these level funded or MEWA type of plans, the pricing is negotiable and it is rated based on the health of the employees of the organization. So what that means is depending on the size of your organization or if you have current coverage, this type of plan can be rated either through a census or through applications, depending on the carrier. And once that goes through underwriting, there is pricing that is determined there, and the broker does have some room typically to negotiate on that pricing. And it's kind of flexible to where there are many different options on those types of plans as well. A MEWA, just so you know, is a multiple employer welfare association, which typically that means that it's going to be through a chamber of commerce, whether it be the Kansas City or, Missouri Chamber of Commerce plans. Next, we've got employers with 50 or more employees. So with the fully insured plans, these are plans that are based on the claims experience of the company. Generally, if you're fewer than 100 employees, there's not going to be any sort of claims data there, but there is some room for negotiating on that pricing from the insurance carrier on the fully insured plans. The self-insured plans are really pretty similar in the plan designs to the fully insured plans. However, there are going to be some slight differences when it comes to the claims fund. So with a fully insured plan, you don't get any sort of claims data, but you also don't get any sort of refund from the claims fund if you have a particularly good year. Whereas on a self-insured plan, you would have that option. Even on level funded plan, you'd have that option to get a refund at the end of the year. All three of those, the self-funded and the level funded plans would provide claims data to you each year, so you have a good understanding of what that risk looks like for you, and it also helps when negotiating for the following year. Some considerations when we're looking at medical plans. Of course, looking at pricing is going to be very important, and the types of plans that we can look at, just as I noted on the previous slides, it's going to be based on the number of employees, on the types of programs that we could look at. However, some other considerations are the plan designs. So looking at what you want your deductibles to be for employees, as well as copays on the plans, whether you want to look at HSA or health savings account compatible plans versus traditional copay plans. And then finally, if you want to look at having multiple options. So many companies that I work with would offer a dual option to where they have an HSA or health savings account compatible plan, but they also offer a more traditional copay plan for the employees that fits better for. The other consideration that we always take a look at when evaluating health insurance options is what that doctor, hospital, and pharmacy networks look like. It's always important, as opposed to just looking, shopping on price, is to make sure that you're going to have the coverage and the carriers, or I'm sorry, the doctors that you're wanting in that network. So breaking down those medical plan designs, just a couple notes in case you're not too familiar. So traditional copay plans, each insurance carrier is going to be a little bit different in what they offer as far as those medical plan designs. But on a traditional copay plan, it could be as low as a $0 deductible. Ultimately, though, the plan will have a maximum out of pocket or a worst case scenario for an employee. So for 2024, the highest and maximum out of pocket can be is $9,450 for an individual. Whereas the other type of plan option, the HSA or health savings account compatible plan, the lowest deductible option is $1,250. If we have a deductible that's that low at $1,250, there would be some sort of co-insurance after you meet your deductible. So you'd end up paying 20% co-insurance afterwards, for example, until you reach, again, whatever the maximum out of pocket is. That maximum out of pocket could be as low as $3,000, but could ultimately be as high as that $9,450 again. So with health savings accounts, again, health savings accounts or flexible spending accounts are options that can be added in. Of course, if you have a health savings account compatible plan, incorporating a health savings account for employees is also something that's available to you. So with the health savings account, this is going to be separate from the actual plan and separate from the deductible and max out of pocket on that plan. But in that health savings account, which is going to be more like a regular savings account, there are limits on how much an employee or employer can contribute to that health savings account per year. So for 2024, the maximum HSA contribution or maximum limit is $4,150. Or if someone's enrolled with family members, the maximum is $8,300 for 2024. If you have someone who is 55 years of age or older, they are allowed to do a $1,000 catch-up contribution each year. So it would increase that maximum contribution option. With that health savings account contribution, there's many different ways to structure that to where you make it available to employees and employees can contribute the amount that they want, fully funded by themselves. Or it could have some sharing where the employer can decide, okay, we're going to contribute a certain amount per year to the employees, or the HSA technically could be fully funded by the employer as well. Separate from that would be a flexible spending account. And I like to put these on the same page to make sure that people understand that there's a difference. Sometimes a health savings account and flexible spending account get confused for one another, or sometimes people think it's the same thing. A flexible spending account is going to be a separate type of account, whereas the health savings account has to be used with a health savings account or HSA compatible plan. The flexible spending account can be used even on the traditional copay plans. So if someone is enrolled in the health plan and they choose the flexible spending account, they're going to have options there to be able to elect into that flexible spending account. But similar to the health savings account, they would have to elect what they want their contribution amount for the year to be. For 2024, the maximum FSA or flexible spending account contribution is $3,050. With that flexible spending account, there's an additional type of plan, which is a dependent care flexible spending account. The maximum contribution on that plan is $5,000 per year. There are one additional difference between a health savings account and flexible spending account. That is, with a health savings account, when the money goes into the employee's health savings account, it's theirs, and there's no pulling that money back or changes to it. So it's just, each pay period money goes into their health savings account. On the flexible spending account, that FSA election is generally available at the beginning of the plan year for them. So it's really careful. It's important to watch that FSA, especially if you have someone leave in the middle of the plan year. There's some important things to really pay attention to on that flexible spending account related to the company liability. With dental and vision, there's, again, many different carriers that are going to offer dental, vision, or basic life plans. Sometimes we see that these are bundled in with the medical carrier for one reason or another, whether it's to help save on the cost or just due to ease. With these plans, similar to medical plans, they can be structured as far as how you want that contribution to be paid, whether it's entirely paid by the company, entirely paid by the employee, or somewhere in between, to where there's some cost sharing there. With dental and vision plans, again, there's going to be many different plan designs that are available, whether it be a type of plan that just covers preventive services or covers your major services as well. So things like crowns and bridges, or going a little bit further in incorporating orthodontic coverage, either for children only or children and adults. So there's lots of things that can be changed there, as well as what you want the co-insurance to be for things like the fillings, root canals, gum treatments, and those types of services. Additionally, things like implant coverage can be added in. Typically, that's not available unless we have 10 or more employees. Same is true to offer a dual option. So having like a base dental plan and buy-up dental plan, that's generally not available until we have about 10 employees on the plan as well. One thing that we tend to see more and more on vision plans is a lot of vision plan benefits look pretty similar to each other as far as co-pays for the eye exam and lenses. Frame frequencies is probably the biggest thing that we see changing more and more, in that, prior to a couple of years ago, it was very common that employers had plans that allowed an employee to get new frames for glasses once every other year. And we're seeing more and more that's changed to once every 12 months, so once per year. It's a little better benefit for those employees. With dental and vision plans, the pricing on those plans tends to be lower if it's an employer paid plan as opposed to a voluntary plan. It really just kind of depends on how that's structured, but typically that's what we see. Additionally, benefits could be a little bit greater as well. So for example, on dental plans, a lot of times if a plan is listed as a voluntary dental, like on dental, if the plan is listed as voluntary, then that type 3 coverage, so coverage for crowns, bridges, isn't available for 12 months. So that's always something to really pay attention to make sure that your employees are getting the benefit that they think they're going to get. Basic life insurance would be kind of along that same piece there, with dental, vision, and life insurance wrapped together. The life insurance is another one of those benefits that sometimes gets bundled in with the medical plan. What we tend to see on life insurance is a setup that's either going to be a flat benefit amount. So for example, $25,000 benefit for the employee, 50,000, even some plans I see at 100 or 200, 250,000 benefit, depending on the salary range of your employees, is what we kind of look at to see what makes the most sense there. If we were looking at a flat benefit, sometimes we look at a plan that is like 1 times or 2 times salary as a way to structure that life insurance, so that each employee, as opposed to just getting a flat amount, it's going to be based on their salary amount. Those plans, the life insurance plans, can also have an added rider on there that would provide coverage for dependents as well. So a spouse rider or child rider that adds some life insurance for those dependents as well. And we generally see life insurance as something that's employer paid. Next, we've got disability and voluntary life. So with disability, we've got short-term disability and long-term disability. And then voluntary life is an option that voluntary life is definitely going to be a voluntary plan option, hence voluntary life. Short-term and long-term disability, though, have options that they too can be 100% voluntary. They could have some employer contribution towards them, or they could be fully employer paid. With disability coverage, so whether it's short-term or long-term disability, the types of things that we look at to structure that type of program is the elimination period, or in other words, the wait period before that benefit kicks in. So for example, a short-term disability plan could have an elimination period for accidents of 0 days. So the plan would start paying on that first day after an accident. Or along with that, it would have a 7-day wait period for sickness. Or those wait periods or those elimination periods could be changed so that it expands that out a little bit further, that an employee has to wait, a full 7 for either accident or sickness, or 14 days for accident or sickness. So each of those, really, by changing those elimination period options, changes what that cost of the plan is going to be. Additionally, benefit periods are something that can be kind of customized as well. Generally, on a short-term disability plan, we see benefits go up to 13 weeks or 3 months. Long-term disability would fall right in line with that, especially if we're coupling short-term disability with long-term disability. We have it so that the long-term disability plan kicks in right after the short-term disability plan finalizes. So with long-term disability, if we were to have that 3-month short-term disability benefit period, then we would have the long-term disability set so that the elimination period is 90 days and fall in line, so that right after that short-term disability finishes paying, then the long-term disability would kick in. One thing that short-term disability in particular is used for is pregnancy. That's not the only thing that's used for. Any sort of accident or sickness, the short-term disability and long-term disability plans would pay for. However, that is one consideration for people, especially younger women still in those maternity ages. Definitely look at short-term disability as an option to help recover some of their paycheck while they're out after having a baby. So the pricing on the short-term and long-term disability plans, I think I had mentioned, tends to be lower when it's employer paid. And the reason that the insurance carriers do that is because they know they're going to have the full participation of the group. If it switches over to where the short-term or long-term disability plan is voluntary, generally what we'll see is that there's going to be some participation requirements. So for example, there needs to be at least 5 employees on the plan. Some carriers will ask for that. And with that, the pricing switches over so that it's age rated as well as being based on an employee's salary. So our older workforce tends to see higher prices on the disability side, no matter if it's short-term or long-term disability. Voluntary life insurance is another option there. So with voluntary life insurance, technically, we could see voluntary life insurance for as low as like $10,000, but ranging on up. The maximum that I tend to see, some insurance carriers will cut off with a maximum of 100,000, but depending on the group situation, they sometimes can expand up to being 200 or 250,000. Others can even go up further than that, say 500,000. It just really kind of depends on the group situation, the salaries of the company, as well as the number of employees that they have. With these voluntary life plans, they do have some options to where there's a certain amount of coverage that would be issued without asking medical questions, so it'd be guaranteed issue. And then if somebody opts over that amount, then they would require the medical questions to be answered. So for example, there could be a situation where an insurance carrier provides an option for a maximum benefit of $100,000 on voluntary life. However, they may set that guaranteed issue amount at $50,000. So as long as the employee is at or below $50,000 in that election, then they won't have to answer any medical questions. However, if they go above that, say they ask for, $75,000, $100,000, then medical questions could be answered. So that's always something that we take a look at and make sure that we talk with the employees about as they're making their selections for each year. The voluntary life insurance is portable. So that means if an employee leaves your organization, they're able to continue to pay that through a home bill. So they can pay directly to the insurance carrier to be able to keep that coverage. That's one important thing for employees. A lot of times, if we're doing assessments for individuals, sometimes we find that life insurance is one thing that they're lacking. We pay for all sorts of insurance in our life, but sometimes we don't think about making sure we have life insurance, especially if we've moved organizations over time and maybe a new organization that we're working for doesn't have a voluntary life option. This is something that's really helpful for people to make sure that they can maintain that coverage. Next, we've got plans that are more supplemental plans. So these would be like accident, critical illness, medical gap type of plans. With these, they are generally, I would say 75% of the time at least, they are 100% employee paid. These types of plans help fill the gap that's left with regular health insurance. So, typically on health insurance, we're going to have copays for our office visits, prescriptions, all any inpatient, outpatient services. So these different plans can help in those areas to help cover some of those costs as well. I mentioned that they're generally voluntary plans, so totally employee paid. However, there is an option that a benefit bank could be set up, or basically a flat employer contribution could be set up so that employers can contribute to these and provide an option for employees to elect what they would like to. Additionally, employers could say, we're going to pay 100% of an accident plan, for example. That would be an option as well on these types of plans. I had listed short-term, especially short-term disability, but short-term disability and voluntary life in a previous slide. However, sometimes those fall into a supplemental life or supplemental plan type of scenario as well, to where they're just totally employee paid, falls under to a similar program, and employees would have those options as well. Some other services or additional things to think about when structuring your program are going to be a benefits administration system, or Ben admin is typically what we'll call it. These are systems that help to consolidate information and can also be set up to where they're integrated with different things like payroll, for example. These bin admin systems, some popular ones are Employee Navigator, eCentral, bSwift, are all some of the more popular ones. More and more, we're seeing different payroll companies start offering things like this as well. And what they do is help kind of streamline the benefits program and make sure all the reporting is there for you. With the bin admin system, sometimes what I like to do is pair that together with an enrollment team. So different enrollment support options are available, as opposed to just setting up that benefits administration system and pushing it out to the employees and hoping that the employees will log in. A lot of times I'll have an enrollment support system set up so that we've got enrollers that will work directly with employees to help kind of talk through their coverage for them, make elections through that bin admin system. Some other considerations, depending on the size of your organization, this may not be applicable, but more and more as employers grow and we start looking at different types of plans, whether they be plans that are self-funded or level funded, we look more and more at analytics, which help us to look at previous claims activity and kind of do predictive modeling on what it's going to look like going forward. Those services help us when we're negotiating with insurance carriers, looking at other plan options for the organization. So depending on the size of company, that's definitely something that we start looking at, especially if we're over 50 employees, even more so when we're over 100 employees. COBRA administration is something that if you've got 20 or more employees, COBRA administration is something that needs to be completed, whether it's done internally by your organization, done by your broker, or through a third-party company. The COBRA administration is that service that reaches out to employees when they're no longer employed to offer continuation of their coverage. 1095 reporting is going to be an added service that the 1095 reporting, if you are on an age-rated type of plan, basically if you have fewer than 50 employees and on that age-rated type of plan, the insurance carrier does it for you. However, if you have more than 50 employees, your company is responsible for doing that 1095 reporting, or that reporting at the end of the year that says each employee had health insurance for X number of months. And that 1095 report then gets sent to each employee and also gets filed with the IRS. The employee communication and different education pieces are a service. Generally throughout the year, there's different things that the insurance industry pushes out, whether it's a Medicare notice or things like that. Different employee communication pieces, especially pertaining to things like wellness, are things that can be pushed out to employees as well. So there are some different services that are available that can do that. particularly related to wellness solutions, not only on the communication side, but that's a really good added service. Some insurance carriers, technically all insurance carriers, have some sort of wellness program. Some will actually reward you for participation in that wellness program, but more and more, especially starting this year, I'm seeing more and more companies that have just decided to create their own wellness program. And some of those are either managed directly by the company, or we've brought on a third-party company that will help administer a wellness program for the company. The other thing kind of tied to the employee communication and press releases would be communication solutions, or not communication, compliance solutions, to make sure, again, things like 1095, or depending on the number of employees, and if you're using a retirement account, a 5500 form, are all things that definitely want to make sure are being completed each year. So especially as I go through a benefits review for companies, these are all aspects that I touch on to make sure that you're getting the best service that you can, and that there's not any boxes that are not being checked for you.